Why 0.1 Bitcoin is the new goal for the middle class. The shattered fortress of the three-fund portfolio. Imagine a stickman named Joe. Joe is the ultimate good student of personal finance. For the last decade, Joe has followed the sacred scripts of the Boglehead philosophy. He has ignored the noise, tuned out the talking heads on financial news, and consistently poured every spare dollar into a low-cost, diversified, three-fund portfolio consisting of Vanguard Total Stock Market, VTI, Total International Stock, VXUS, and a modest slice of Total Bond Market, BND. Joe believed he was building an unassailable fortress. He believed that as long as he stayed the course, the global economic engine would eventually deliver him to the shores of a comfortable retirement. But as Joe wakes up on a Tuesday morning in the year 2026, he performs a forensic audit of his surroundings, and the air feels different. The headlines are no longer about corporate earnings or interest rate pivots. Instead, the world is vibrating with what experts call geopolitical noise. The news is dominated by the Greenland Gambit, sweeping new tariffs, and a growing sentiment among international fund managers known as the Sell America trend. For the first time in Joe's life, people are openly reassessing the risk of holding United States assets. The United States dollar, once the undisputed king of the global ledger, is showing cracks in its armor. Joe looks at his portfolio. On paper, he has reached the $20,000 silent alarm threshold we discussed in earlier audits. He even has the $50,000 in cash that makes traditional banks nervous. But through his forensic lens, Joe realizes that while his nominal numbers are high, his sovereign purchasing power is evaporating. He is witnessing fiscal drag and currency devaluation, stealing approximately 3% of his wealth annually. He is realizing that the great wealth transfer of $84 trillion he expected to inherit is being targeted by invisible erasers before it can ever reach his hands. In this environment of 2026, Joe discovers a new, quiet consensus forming on forums like r/Bogleheads. Even the most conservative index and chill investors are making marginal defensive adjustments. They aren't panicking, but they are seeking an architectural lifeboat. They are moving toward a new, specific goal that was once considered a fringe fantasy, but has now become a strategic necessity for the middle class: the acquisition of 0.1 Bitcoin. Today, we are performing a surgery on the middle-class anchor. We are going to look at why 0.1 Bitcoin has become the new mathematical line in the sand, how it acts as a hedge against the geopolitical noise of 2026, and why your smart order of operations must now include a slice of the global digital ledger if you want to survive the Sell America era. The Scarcity Math and the Sell America pivot. To understand why Joe, the conservative, index fund-loving stickman, is suddenly looking at a decentralized digital ledger, we must perform a forensic audit of the global supply of assets. For decades, the S&P 500 was the ultimate anchor because it represented the collective productive capacity of the largest economy on Earth. But in 2026, the architecture of that anchor is changing. The S&P 500 is an infinite paper construct. While the companies are real, the shares can be diluted, and the currency they are denominated in, the United States dollar, is subject to what we call institutional erosion. Our audit of the International Monetary Fund reports for 2026 reveals that global growth is divergent. While technology is boosting productivity, geopolitical fragmentation is creating a war drag on energy importers and energy-dependent economies. In this environment, Joe is encountering the Sell America trend. International fund managers are no longer viewing the United States as a risk-free sanctuary. With the Greenland Gambit and sweeping new tariffs creating geoeconomic confrontation, now ranked as the #1 systemic risk by the World Economic Forum, foreign allocators are quietly trimming their U.S. exposure. Joe sees this reflected on his favorite forums. On r/Bogleheads, users are reporting a strategic shift, moving from a heavy 80% U.S. allocation
toward global market weights of 63% US and 37% international. They are seeking currency sovereignty. But even international stocks are still tied to the traditional banking architecture that we audited in previous sessions. The same architecture that gets nervous when you have $50,000 in cash.
This is where the 0.1 Bitcoin goal enters the frame. The mathematics of 0.1 is not arbitrary. It is a calculation based on absolute architectural scarcity. There will only ever be 21 million Bitcoin. In a world of 8 billion people, if every single person wanted an equal share, they would only be able to own 0.0026 Bitcoin. By reaching the threshold of 0.1, Joe is securing a position that is 38 times larger than the fair share of the global population. Through our forensic lens, we see that 0.1 Bitcoin is the middle-class anchor because it represents a fixed percentage of the global ledger that cannot be erased by fiscal drag, diluted by corporate share offerings, or seized by a bank's high-engagement algorithm. According to our audit of digital estate planning, sovereign cryptocurrencies like Bitcoin are the only assets Joe truly owns via direct private ownership. Everything else in his Vanguard account is a contractual claim held by a custodian. If the geopolitical noise of 2026 turns into a geopolitical signal, those contractual claims may face probate delay or legal freezing. But Joe's 0.1 Bitcoin remains liquid as long as he holds the private keys. The consensus among the new Bogleheads is not that Bitcoin will replace the S&P 500, but that it must act as the hard deck for the portfolio. If the S&P 500 represents the engine of Joe's wealth, 0.1 Bitcoin represents the hull of his ship. In a calm sea, you only care about the engine. In the stormy outlook anticipated by 50% of global leaders in 2026, you start caring very deeply about the hull. In the next part, we are going to look at the positioning protocol for this digital anchor. We will analyze the risks of the crypto trap that keeps the middle class poor, how to avoid the permanent capital loss scenario of misplaced keys, and why 0.1 is the exact amount that satisfies the mathematical requirement for a success script in the barbell economy. The crypto trap and the illusion of exposure. Joe is ready to act. He has seen the math. He understands that in the Sell America era, owning a piece of the global digital ledger is the only way to ensure his sovereign purchasing power doesn't vanish. But as Joe enters the digital asset markets of 2026, he immediately encounters the crypto trap. Our audit of retail investor behavior reveals a tragic irony. Most people who think they are investing in Bitcoin are actually just participating in a new form of financial serfdom. They buy their exposure on centralized exchanges, the very institutions that our previous audits showed get nervous and implement high-engagement harvesting when your balance reaches $50,000. When Joe buys Bitcoin on a major exchange, he doesn't own Bitcoin. He owns a contractual claim on Bitcoin. Under the terms of service, which Joe, like most stickmen, didn't read, the exchange effectively treats his deposit as an unsecured loan. If the exchange faces an algorithmic collapse or a regulatory freeze under the new global tax deal protocols, Joe is just another creditor standing in a line that moves at the speed of a snail. This is the first layer of the crypto trap, the confusion between price exposure and architectural ownership. Joe doesn't need the price of Bitcoin to go to the moon as much as he needs the sovereignty of the asset to protect his hull. If he leaves his 0.1 Bitcoin on an exchange, he hasn't escaped the traditional banking system. He has just moved into a less regulated, more volatile version of it. The second layer of the trap is volatility sabotage. In 2026, the geopolitical noise creates massive price swings. Middle-class investors often treat Bitcoin like a lottery ticket rather than a middle-class anchor. They use leverage, borrowing money to buy more, and when the price drops by 20% on a Sunday afternoon because of a headline about the Greenland Gambit, their positions are liquidated. Their capital is harvested by the platform's algorithms. On forums like r/Bogleheads, we see users like SufficientWall1445 lamenting that their digital asset holdings failed to act as a reliable inflation hedge. Our forensic audit suggests this is because they were seeking yield instead of protection. They were chasing the dragon of Ethereum, or speculative altcoins, instead of securing the one asset with absolute architectural scarcity. To avoid the trap, Joe must implement the smart order of operations. He doesn't buy his 0.1 Bitcoin all at once with dry powder he doesn't have. He ignores the FOMO. Instead, he treats it as a repeated lump sum every paycheck, just like his Vanguard contributions. He views 0.1 as a destination, not a trade. The Digital Sovereignty Protocol and RUFADAA security. Once Joe reaches his goal of 0.1 Bitcoin, the forensic audit shifts from acquisition to preservation. In the year 2026, the greatest threat to Joe's digital wealth isn't a market crash, it's a legacy gap. As we explored in our audit of the wealth transfer, the revised Uniform Fiduciary Access to Digital Assets Act, RUFADAA, has created a hierarchy where online tools override traditional wills. Joe's Bitcoin is a sovereign asset, meaning it exists outside the probate court's ability to reset a password. If Joe dies without a protocol, his 0.1 Bitcoin is legally his, but mathematically, it is dead capital, lost forever on the blockchain. Joe implements the Sovereignty Protocol in 3 distinct steps. Step 1. Cold storage and private key custody. Joe moves his 0.1 Bitcoin off the exchange and into a hardware wallet. He understands the mantra, not your keys, not your coins. By holding his own private keys, Joe moves his wealth from the contractual claim column to the direct private ownership column. This is the only asset in his entire net worth, including his house and his index funds, where he is the primary sovereign authority. No bank can freeze it. No fiscal drag can quietly erase it. Step 2. The RUFADAA Trust integration. Joe knows that sovereignty can become a trap if he is the only one who can access the vault. He utilizes the trust model of estate planning. He places his hardware wallet and the associated seed phrases, the 24 words that act as the master key, inside a revocable living trust. He appoints a digital executor, someone who understands the difference between a public address and a private key. This designation ensures that the $84 trillion wealth transfer doesn't hit a digital wall. By using the trust, Joe ensures that his family has the legal authority and the physical means to bypass the 2-factor authentication locks that big tech uses to harvest residual digital value. Step 3. The MAGI Protection Shield. Finally, Joe audits his Bitcoin strategy for tax efficiency under the One Big Beautiful Bill Act, OBBBA. He realizes that selling his Bitcoin for a win could trigger a jump in his modified adjusted gross income, potentially causing him to lose his standard deduction benefits or future senior bonus credits. Joe decides to treat his 0.1 Bitcoin as generational hull. He doesn't plan to sell it to buy a depreciating asset like a car. Instead, he follows the strategy of the hidden millionaires on r/themoneyguy. He focuses on paying off high-interest debt and maxing his health savings account and Roth IRA first. His Bitcoin is his hard deck, the capital of last resort that ensures his family is never harvestable by a crashing currency or a desperate government. The forensic verdict and the sovereignty conclusion. Joe finishes his forensic audit of the global landscape, and for the first time in years, the noise doesn't bother him. He has realized that the traditional Boglehead strategy of index and chill is not dead. It has simply been upgraded for the architectural realities of 2026. The verdict from our audit is clear.
In an era of divergent forces and geoeconomic confrontation, now ranked as the #1 systemic risk by the World Economic Forum, your portfolio requires more than just an engine of growth. It requires a hull of sovereignty. Joe doesn't sell his Vanguard total stock market index funds. He doesn't abandon the productive capacity of the 500 largest companies in America. Instead, he treats his 0.1 Bitcoin as the hard deck of his wealth. If the S&P 500 represents his ability to participate in human progress, his Bitcoin represents his ability to protect that progress from fiscal drag, currency devaluation, and the invisible erasers of the system. On the forums of r/Bogleheads, the consensus has shifted. Investors are no longer debating if they should own digital assets, but how to secure them without triggering the crypto trap. They are utilizing the repeated lump sum approach, pouring a fixed amount into their digital anchor every single paycheck, ignoring the volatility of a Sunday afternoon, and focusing on the absolute architectural scarcity of the 21 million cap. By reaching the threshold of 0.1, Joe has secured a position that is 38 times larger than the global fair share. He has moved his capital from the contractual claim column to the direct private ownership column. He has implemented the RUFADAA Trust Protocol, ensuring that his digital kingdom doesn't hit a digital wall during the great wealth transfer. Joe is no longer a harvestable resource for the banks that get nervous when he has $50,000 in cash. He is a sovereign capital allocator. He has used the smart order of operations to build his $1,000 starter buffer, his $20,000 silent alarm, and his 0.1 Bitcoin hull. In the year 2026, the middle class is being squeezed between the big freeze of the labor market and the fiscal drag of the tax code. You can either stay on the treadmill and wait for the system to harvest you, or you can build your own bridge to freedom. Joe chooses the bridge. He chooses the hull. He chooses to opt out of the sell America collapse and into the sovereignty script. The sign-off. The mathematics of the barbell economy are cruel to those who remain passive. True wealth in 2026 is the ability to see through the geopolitical noise and recognize where the real anchors are located. Don't be the stickman who stares at the S&P 500 while the currency erases your hull. Build your vault, secure your keys, and reach for the anchor. If this forensic audit of the middle-class anchor changed how you view your portfolio, hit that subscribe button. We are dissecting the hidden equations of the 2026 economy every week to help you stop being the crop and start being the owner. I'm Joe from fin.stickman, and I will see you in the next one.